A three-digit number sits at the center of a loan decision. It does not measure wealth. It measures obedience to a specific financial pattern. Banks use this number to decide how much to lend you and at what cost. A lower number means higher interest. A higher number unlocks better terms. The score is calculated from 5 behavioral inputs. Payment history carries the most weight. The system rewards consistency above almost everything else. Miss one payment, and the tallest pillar shrinks immediately. The system does not weigh intent. It records the outcome and adjusts the number downward. Rebuilding the score after a drop takes significantly longer than the drop itself. Well, the system falls quickly. It recovers slowly. That symmetry is by design. The second input is credit utilization. It measures how much of your available credit limit you are currently using. Lower usage signals lower risk to lenders. Spending heavily on a card, even if you pay it off monthly, temporarily raises your utilization. The score captures a snapshot, not your full behavior pattern. The third input is credit history length. The longer your oldest account has been open, the more it contributes to your score. Age in the system has real value. Closing an old account removes that history. Your average account age drops. The score may fall, even though your financial behavior has not changed at all. The fourth input is credit mix. Having different types of credit, installment loans, and revolving accounts, signals that you can manage multiple formats at once. The fifth input is new credit inquiries. Every time a lender checks your score, it creates a small negative mark. Too many checks in a short period signals financial stress. These 5 inputs combine into a single output number. That number then travels outward and affects the cost of decisions you have not made yet. It moves before you do. A high score does not mean you have money. It means you have reliably followed the borrowing system. Wealth and creditworthiness are 2 different measurements entirely. This separation matters. A person with modest income and perfect payment discipline can outrank a wealthier person who carries too much open credit at once. The trap begins here. To build a high score, you need to borrow. But to borrow safely, you need a high score first. New borrowers face this loop immediately. Credit builder products exist to solve this problem. They allow a person to pay into a system that reports behavior without actually extending purchasing power first. Once a score is established, its effect reaches beyond lending. Landlords check it before renting apartments. Employers in some sectors review it before hiring. The number follows you. The score becomes a proxy for trustworthiness. This is the quiet expansion of the system. It was designed for lending decisions, but its reach has grown well beyond that original purpose. People who grew up outside formal banking systems often start with no score at all. Not a low score, a blank absence. That absence is read as risk by institutions that use the number. The system cannot distinguish between someone who is risky and someone who simply has not participated. Both are treated identically at the point of the first application. A low or absent score does not just block access to loans. It raises the cost of the ones that are approved. Higher interest rates compound over time into meaningfully larger total payments. The cost difference between a good and a poor score on a long mortgage can reach tens of thousands of abstract units of value over the life of the loan. The number has real weight. This is a good place to pause and mention that this channel regularly explains economic mechanisms that shape everyday decisions. Subscribing means you will not miss the next one. One of the counterintuitive rules of the system is that paying off all debt does not always produce the highest score. Lenders want to see active management, not elimination. The optimal score requires keeping some credit active, some utilized, some aged, and some recently managed. This is not wealth optimization. It is behavioral compliance optimization. People who optimize around the score begin making financial decisions based on what the algorithm rewards rather than what serves their actual economic situation best. Keeping a card open to preserve credit history is a real strategy. The card charges an annual maintenance cost. The score benefit retains its value only as long as the card stays active. The system has created a maintenance cost for the score itself, not the debt, just the score. This is the trap at its most visible. The tool begins requiring resources to sustain itself. Errors in credit reports affect millions of people. A misrecorded payment, a duplicate account, or a fraudulent entry can drag a score down for months before resolution begins. Disputing an error requires contacting the reporting bureau, providing evidence, and waiting for a review cycle that can take several weeks. The score stays low throughout that period. The score is not calculated by one system. 3 major bureaus operate independently, and they can produce different numbers for the same person based on different data inputs. Lenders may use any of the 3 bureau scores, or they may use a weighted average. The person applying has no advance visibility into which number will be used for their decision. Rate shopping. Comparing loan offers from multiple lenders can trigger multiple hard inquiries. The system penalizes the behavior of finding the best price. Seeking competition has a visible cost. Some scoring models group similar inquiries within a short window, treating them as one event. Others do not. The borrower rarely knows in advance which model the lender will apply. Credit scoring models are updated periodically. A score calculated today may differ from one calculated 3 months ago, even if the underlying account behavior has not changed at all. Alternative scoring systems are being developed. These use rental payment history, utility payments, and banking activity to assess reliability without requiring formal credit behavior as input. These alternatives are not yet universally accepted by lenders. Most major lending decisions still rely on the traditional model. The new systems exist but have limited reach so far. Income is not in the credit score. Employment stability is not in the credit score. Savings are not in the credit score. The number measures only how you manage credit products in the past. A person can be financially stable, no debt, consistent earnings, regular savings, and still carry a mediocre score, because the system has no mechanism to record those behaviors at all. The system was designed to solve a real problem. Lenders needed a consistent, scalable method to evaluate millions of applications. A single number made that process fast and uniform. The efficiency worked. Default prediction improved, but the tool designed for lender convenience gradually became a requirement that borrowers had to actively manage and maintain over their lifetimes. Managing the score is now treated as a basic financial skill, but that expectation assumes that everyone starts with equal access to the credit products the score requires as inputs. The score is not the problem, and it is not the solution. It is a measurement tool that has grown to define eligibility in areas far beyond what it was originally designed to evaluate. People who learn to work within the system's logic can position themselves well. The input requirements are learnable. The maintenance is manageable. Understanding the rules changes the outcome. The engine keeps running. Inputs continue arriving. The number keeps adjusting. Somewhere inside the system, the next rule that no one fully explained is already shaping someone's next application.